But I always tell my clients, and I do this for myself, is get ahead of the game.
Right.
Make your contribution now for next year. Why scramble on February 28th or the 60th day after the year end to get that tax return or that contribution made? Make it early.
Welcome everyone to True Patriot Love. Today I'm lucky enough to have Luigi DeRose from PwC. He's a tax partner. And I know this time of year, everyone's starting to struggle with their income tax. And even recently, I was reading an article, Luigi, and Fortune printed it and came up with it. And they basically said 1 in 4 Gen X taxpayers consider therapy during tax time.
Okay.
So see what you're doing?
Yeah.
And not you. Welcome.
So the government's doing it.
The government's doing it. Yeah,
thank you.
You're just helping, you know, and that was actually part of the cure was actually getting a professional to help them with their income tax. And the number one thing I thought it was interesting, because these are 20-year-olds, you know, God love them. I remember those days. These are 20-year-olds who are working in the gig economy. They're working multiple jobs. They have side hustles. When it gets to tax time, they have all these different machinations. They have contracts, they have employment income, they have contract income, and they're trying to figure it all out. They even have crypto investments, right? Which is complicating the heck out of their lives. Yeah. God love it. So, you know, they have all these fears. And I thought it was interesting. Their number one fear is making a mistake, which that's kind of odd, you know.
Mistake on what? Their tax filings?
Their taxes, yeah. Okay. Yeah, that's the number one fear, which I thought, I don't know if I ever had a fear of making a mistake on my taxes, right?
Yeah.
I mean, maybe I did. I don't remember it. But 33% of Gen X's, that's their worst fear, and 27% of millennials. So it is it's definitely a fear for people. It gets less as people get older, of course. And then their next fear is worry about scams and data exposure. So they worry that their taxes are going to be provided to someone else. Yep. They're going to get caught in a tax scam.
Yep.
And then finally, I think this is the biggest fear for all of us, fearing owing more money than you can afford, right? Because if you have your own business or you're working a side hustle, you know, quite frankly, did you put enough tax aside to pay your tax bill at tax time, right?
Yeah,
Which
for sure.
I know myself, when I started my own business, you know, allocating funds and setting aside money was one of the biggest challenges, right? Because you want to double down on what you're doing.
Yeah, people want to spend the money in the business to grow the business, not to pay taxes. That's for sure.
Exactly. So Christoph, who helped me with this today, and thank you for your help, I said to him, put together a list of key things that people worry about, are concerned about, ask questions about. And the first thing they came up with was upcoming filing deadlines. Mm-hmm. So do you share with us some of the deadlines, and you know, we can talk about what's coming up.
So everyone should know about the April 30th personal filing tax deadline. Your taxes are due, all of us as individuals in Canada as taxpayers, your taxes for the 2025 year are due April 30th. Mm-hmm. For those that are self-employed or who have a spouse that's self-employed, their tax returns aren't due till June 15th, but if they owe money, the tax is due by April 30th. And then the other one I'll mention is corporate taxes. If you have a business that's incorporated, those tax returns are due 6 months after the year end.
Yep.
So most businesses that have December 31st year ends, the tax returns are due June 30th. So those are probably the 3 most significant deadlines coming up in the short term.
Tell me, so this, I got to ask you, because this is, I lived this. So Luigi knows, you know, I didn't work for PwC, but I worked for another of the big 3 accounting mm-hmm. firms. Tax time in my life was brutal, right? So the amount of hours. So, and you know, I know working for one of the major accounting firms and being in tax, you're probably not as stressed as I was, but I was a kid. I was in my early to mid 20s. I was trying to become a CA in those days. We weren't called CPAs. Yeah. And we used to work like 100 hours a week. It was crazy the amount of hours we worked during tax time, because we had all our clients and all their kids and everyone mm-hmm. flooding in. Is it, you know, probably not as much because it's now electronic, but is it still as hectic as it used to be?
It's always hectic because, you know, I describe it as like the tax season is so short. You get tax slips sometimes in early April, and the tax returns are due April 30th. So it's such a constrained time period to get all your clients' tax returns done on time. You're right. With the advent of things being able to do tax returns electronically, AI helps us a lot nowadays in terms of assembling and inputting some of that data. So we do save some time there, but it's still like a hectic period of time. I always say if April was just doing tax returns in our business, it would be fine. The issue is that you have all your regular client work going on, and now add personal tax season on top of that. So that's kind of what creates the stress, the extra hours, the extra pressure.
Yeah. Do you still hire? So this is interesting, and I always tell kids today. I didn't stay in public practice. I became a manager, and then I left. You're a partner, so you made a career out of it. I entered it, and I did it kicking and screaming. So I think I've told you the story over lunch. I became an accountant because my mother actually, when I graduated university, used to get my mail. I didn't live at home, and my mother used to get my mail. She opened my mail and she applied to accounting firms.
On your behalf?
On my behalf. I liked the job I had. I had a side gig. I was loading trucks at Canada Packers, and I was making a ton of money.
Yeah.
And my mom actually applied for me to actually go work. She wanted me to be a professional, right?
Right.
And God love her soul. And so she applied for these jobs, and they would come back, and she would set up my interviews and call me and say, "You better make that interview or you're not coming back for dinner." So, because I used to see them every Sunday.
Yeah.
So she made sure that I went to the interviews. I didn't want the jobs, but I got the one company. They hired me. And quite frankly, it was the best thing that ever happened to me.
I was going to say, look at you now. It's all the better for you.
Yeah, it was terrific because it actually, for young people who want to get into business and see a bunch of different businesses, you get to see what you like, what you don't like, businesses you get to work in. And quite frankly, you learn a little about a lot early in your career, which is invaluable because then you get to use it. The other day I was on a show, I was doing a podcast, and Monsanto Canada came up. And I did the audit for Monsanto Canada as I became a manager, right? And so the cool thing about that is I knew everything, like not everything. I knew a lot about GMOs, and I knew a lot about that business. I had been in meetings with them. I had learned about it as an audit manager and what they did. Fertilizer. I learned a lot about it. Their business by doing the audit of it. And it's cool how years later you use that knowledge to come back in even podcasting.
Yeah.
And then your financial, background. Now, I got to admit to you, when I wrote my UFEs, which for those of you who aren't accountants, in those days, we used to have 4 hours, 4 days of exams to become an accountant. When I wrote my UFEs, I skipped all the tax questions. So, and I skipped them and left them to last every time and went back into them because that was my worst, that wasn't my strength, right? So in the end, you can tell, but it did come back. So, help me out a little bit because I'm going to jump in here. So tax credits and deductions, right? Any tips that you see people forgetting, as they get into their tax season?
The biggest tip I'll suggest is CRA actually has a very useful online guide, their T1 guide.
Right.
It's actually very helpful in plain English deductions and credits that you're able to claim on your personal tax return, things that you don't think about, things that maybe haven't applied for you ever that maybe suddenly start applying given your stage in life. A common one that I see as people age is the disability tax credit. As our parents, our family, as we get older, you're less mobile. You may have issues walking. You may have issues feeding yourself and whatnot. So claiming the disability tax credit would be one thing that I think you should be mindful of as you're preparing tax returns. But there's a lot of other ones: medical expenses, tuition credits, RRSP deductions, first home savings account deductions. There's a plethora of deductions that are available to individuals. A lot of times, you talked about the fear of preparing tax returns and overpaying tax. It's because people don't know that all these deductions are available. So either hiring a professional to do your tax returns, who's aware of these deductions, helps a lot. And taking a look at the T1 guide if you're preparing your own tax return. Like I said, CRA does have a useful guide that walks you through the credits, the eligibility criteria, so that you can claim them appropriately if you're doing your own tax returns.
Yeah. The old paper day tax returns, are they still there? Are they gone?
They're still there. They're still there. We don't see them in practice, obviously.
Yeah.
You can e-file tax returns now. They're, I think gone are the days where I remember when I started too, you'd assemble a tax return, attach all the slips. Sometimes it's a big, thick package and you're carrying it to CRA and then you're waiting for it to be assessed. Now you can e-file your tax return instantaneously. You get a confirmation instantaneously that the CRA has accepted your tax return. And in a lot of times, if you're filing early enough, you get your tax refund in the matter of a couple of weeks. So, I'll say things have become a lot more streamlined over the last number of years.
Yeah, thank goodness. It's funny when I think back in the old days, when I was a kid, like 13, my mother actually sat me down, and my dad had trucks. He drove a truck, and he used to have all the trucking logs for meal expenses and for mileage and everything on the trucks. And we would sit at the kitchen table, and she always did his books for his company and his finances. And she would sit there and we would file this huge stack of papers with the actual physical slips. Yeah. And, we'd go and try to copy them somewhere, and we'd sit there for hours, putting nickels in the photocopier. We'd have this big stack. Yeah. Boy, it's changed.
It has changed a lot. Yeah.
So, medical expenses, which is an interesting one, because I know, with my business and with my family and being an entrepreneur for most of my life, it was one of those ones that, I had to kind of remember all the time that there were deductions for people who work, by themselves, that aren't supported by a plan. And that's one I missed all the time. Yeah. And until I got a really good tax accountant, like yourself, I was really never filing anything for my family or benefits. So it's really good to remember.
Yeah, for sure.
RSPs. So too late now, right?
No. I say it's never too late.
Okay.
It's too late to make a contribution now and claim a deduction on your 2025 tax return.
Right.
Because you have 60 days after the year end to make your contribution for the previous year. But I always tell my clients, and I do this for myself, is get ahead of the game.
Right.
Make your contribution now for next year. Why scramble on February 28th or the 60th day after the year end to get that tax return or that contribution made? Make it early. The money grows tax-free inside a RRSP account. So if you make that contribution now, you've earned, 7-8 months of tax-free growth, as opposed to it sitting in a bank account and you're paying tax or not earning anything on it. So I always say the sooner the better. Yep. Get ahead of the game and not kind of scramble to make a contribution at the last minute.
Is there any, and this is an interesting, and probably not for a lot of people, but I have heard, I've sat at dinner tables and had conversations with people. They say they don't do RSPs. And because they don't expect their tax bracket to change upon retirement.
Yeah.
Probably an instance where you wouldn't do an RSP, right? You'd be looking for another avenue.
There's so many different schools of thought on this, and so there's not a right answer. As you alluded to, I think a lot of people think, when you make an RSP contribution, you get to claim a deduction against your taxes, so it reduces your taxes and you make a contribution. When you withdraw the RSP upon retirement, because it is a registered retirement savings plan, so the goal is that you're helping yourself save for retirement. Now it's taxable as income.
Right.
So the conventional thinking was, I'll make less money then, so I get a deduction now at a higher tax bracket. I'll withdraw it when I'm at a lower tax bracket. If you're in the higher tax bracket, you don't have that the tax leverage advantage that you're alluding to. But think about all the years of tax-free compounded growth. So if you don't put that money in RSP, where are you putting it? You're putting it probably in a taxable account. So you're paying tax over 10, 15, 20, 40 years, where it could be growing tax-free in RSP, getting 100% returns for yourself, as opposed to half of it going to the government in taxes. So there are people that kind of are, disparage RSPs and think there's a negative connotation to them. But there's a different school of thought where essentially, as I said, there's a lot of benefits in terms of the tax-free compounded growth over X number of years.
Yeah, and I think that's really the important part is you find yourself a good investment advisor. So on the investment side, that can get you that growth, right? And that I think, and that's my dinner conversation all the time. I say to them, you have the wrong investment advisor.
Right.
So it's not the fact that you shouldn't do RSPs.
Right.
It's the fact, quite frankly, that you got to find someone who smartly invests your money to get you that growth inside the RSP.
Absolutely. It goes back to the previous question about when to make an RSP contribution. I find when people are scrambling to make it at the 11th hour, they just park it in a bank account inside their RSP. So now it's not doing anything for you.
Yeah.
But if you make it early enough and you hire a good investment advisor, you have a plan on how to invest that contribution that'll grow for you.
Yeah.
It makes a big difference.
I do remember that in my early days when I used to do it and I was just scrambling all the time and then would sit there for years not going anywhere.
And not doing anything about it.
Yeah. And then finally I said, I got to get someone. And believe it or not, it ended up being a gentleman that I started with to become an accountant.
Okay, yeah.
And him and I actually went through and wrote our UFI together. And I found him years later and he's an investment advisor. He's doing really well.
Okay.
And I said to him, whatever I do with this, you got to make sure it grows. So every year I sit down, I have lunch with him, we review the portfolio, we go through the performance. He kind of sets a goal or a target for the upcoming year. And thank goodness he's disciplined enough to track me down, make me go to lunch, take me through it, give me sort of a plan for the upcoming year. So you have to do that. That's really, absolutely. And that's important. Who should be filing returns? So this is an interesting one. When you look at it and you say, okay, people sometimes don't need to file, right? And why not?
Yeah, so a lot of people think, well, I didn't make any money this year or only made a few $1,000s. I'm not going to pay any taxes. So why bother the aggravation as we talked about? Why bother paying an accountant to do a tax return when I know I don't owe any money? And I say that's not necessarily the best way to look at it because you're leaving money on the table by not filing your tax return, even if you don't make a lot of money. Things like, if you had employment income, even if it's a part-time job for students, there were source withholdings. Well, because you maybe you're in a lower tax bracket or above the threshold where you even pay taxes, that's tax money coming back to you.
Right.
So why not claim it? And then a lot of credits are available only when you file a tax return. So things like, again, low-income earners, GST credit. You've been hearing a lot about this grocery rebate the government's talking about. Yeah. That's available to low-income earners only if they file their tax return. So if you don't file your tax return, you don't get it. The government doesn't know that you're a low-income earner, that you're entitled to this credit. For seniors who receive old age security and in a lower bracket, there's a top-up payment called the Guaranteed Income Supplement. Mm-hmm. That's only available if you file your tax return and CRA can assess that you are a low-income earner to be entitled to that credit. So I would say, you should probably, I don't want to say everyone should file a tax return, but almost everyone should file a tax return because you're leaving money on the table otherwise.
Right. And from a corporate perspective, right, definitely file because there's a penalty if you don't.
That's right.
So,
yeah.
and it's pretty substantial. I think it's like $1,000 a year or whatever. Or
it's a pretty big, it depends on if you owe taxes, but just the fact that not filing a tax return, there are penalties for not doing so.
Yeah. I learned that the hard way when I first got into business, right? I had a nil. I actually had a company, but it was just really inactive. Yeah. It was a nil company and I filed in late and I got hit with a $1,000 penalty.
Depends if there's forms to file, like all those sorts of things. Even if you don't pay tax with a corporation, there's other forms that are required to file. So you could be assessed penalties for not filing those forms, even though you didn't owe any tax. Yeah. So an important reminder for sure.
TFSA versus an RRSP. Take me through, always it's a question that comes up and I'm not the right one.
Yeah, it's a good academic question. And there's not a right answer. I mean, what I tell people is if you have the money and you can afford it, do both. Because the RSP, as we said, you get a deduction and the goal of the RSP is a retirement savings plan. So there's one kind of purpose for the RSP. Mm-hmm. The tax-free savings account is different. It's not necessarily meant for retirement, although you can use it for that as well. I think about that, a little bit more of for short-term investment goals. You're planning to buy a car in a few years, or for younger people to pay for schooling or things like that.
Right.
That's kind of where the TFSA makes more sense. The difference is that you don't get a deduction when you make a contribution to a TFSA. like you do for an RRSP.
Right.
And on the inverse, as we talked about earlier, when you withdraw from the RRSP, it's taxable. When you withdraw from the tax-free savings account, it's tax-free.
Okay.
So there's pros and cons to both. And I think you have to look at what's your objective. What are you trying to save for? If it's retirement, probably the RSP makes more sense. If it's for a more shorter term goal, probably the TFSA makes more sense. But again, I don't think it's necessarily one or the other all times. You have to look at your specific fact pattern, and what makes the most sense for you.
Okay. All right. So you would do both if you could.
I would do both if you could.
Okay.
Absolutely. Yep.
All right. Tax records. So now
Yeah.
this is an interesting one. So it used to be 7 years.
So it's 6 years from
6
the
years.
end of the year to which the income relates.
Okay.
Okay. But practically 7, right? Because if you think about it, the end of the year,
Right.
so 2019 filings, you should keep until the end of 2025. Right?
Okay.
So that's kind of, you are now in your 7th year when you can shred those records.
And then you can shred them, and then you're basically non-auditable after that.
Okay, so this is where it becomes tricky, because although there is a 6-year record retention policy,
Yeah.
that's from the end of the year to which they are relevant. So your tax return you can shred,
Right.
but and tax slips for that year you can shred. But let's say you bought an investment 15 years ago, a house, a rental property, even marketable securities. If you still own it, you have to keep the records to be able to prove what you paid for it. So it's only 6 years after you sell it, the year of which you sell it, that you can destroy the purchase records. So if people bought houses 50, 60 years ago, they should be retaining those records until they can appropriately calculate a capital gain and pay tax on it on their tax return.
Right. Because
so there's
the cost data.
You need the cost data, any improvements, anything like that. You need proof of that in case CRA asks to review those records. So it's not as simple as saying you have to keep them for 6 years. I think there's certain things you keep for 6 years, some things you have to keep forever.
I definitely, and that's why I do take after my mom. I have a filing cabinet with almost everything way back when in that filing cabinet from my first filing, which at some point,
some you probably don't need.
It's time, right?
Your tax returns from when you were 16 years old, you can probably shred. But
the amount of times I move, I should get rid of it.
Yeah, absolutely. Yeah. Purge your records.
Is there anything that you earn that is tax free?
Okay, so in Canada, there's not too much. There's very few things that are tax free. But if you're lucky enough to win the lottery earnings are tax free.
Gambling revenues.
Well, I don't know about that. I think if it's a business, you're paying tax on it. So I wouldn't say gambling earnings are tax free, but lottery earnings. When a principal residence, if you have a gain when you sell your principal residence, that's tax free. But you only get one principal residence. So people that have like a secondary home, a cottage or something like that, in addition to, they call it their city home, only one of it can be tax free. You're paying tax on the gain on the second one. Life insurance proceeds. So, unfortunately, it's, those pay out when you pass away. So you don't receive that money tax free, but your estate or your trustees can receive that money tax free. And that's useful to pay your debts that are owing when you pass away. Yeah. Those are the main things that I would say are tax free. There's not much else. Small business corporations on a sale could be tax free, but there's a whole bunch of rules and around those that some shares are tax free, some are not. You have to do the full analysis, but I would say those are probably the 4 things that come to the top of my mind that would be tax free in Canada.
Okay, good. Capital gains. Let's talk about those for a minute. So, now, as you mentioned, this one was a big one. And actually, we did a show on it, which I thought with Franco Terrazzano. He's the gentleman that actually filed a lawsuit against the government because they were going to change the capital gains tax on investment income. Yep. Right. And that was after the fact, just saying it does need to go through the full steps before you enact it. It really, I think it got settled out very quickly. And I think it was just to show the government that they had to take more steps before they actually changed capital gains. But, capital gains, very interesting because right now there's always this debate, are we going to increase the rate on capital gains? Are we going to basically add more things into the capital gains pool? What's the scuttlebutt on capital gains right now? Is there anything like happening with it?
The good news is no. I think so. What happened a few years ago is the Trudeau government were proposing to increase the inclusion rate on capital gains from 50% to 2/3. And
Right.
what that means is that, when you're in something like employment income, interest income, if you earn $100, you pay tax on the full $100. But when you generate a capital gain from the sale of an investment, the sale of a property that's, a capital asset, you only pay tax on 50% of the gain. So you make $100, you only have to pay tax on $50. 50 of it is tax-free.
Right.
So they were proposing to increase that inclusion rate to 2/3. So you'd pay tax on $66.67 of the $100 that you gain, which would have been a significant tax increase.
Oh, yeah.
But that created a big uproar amongst not only the investment community, but you think about people that had a cottage that they've had for many, many, many years, and to pay 50% tax instead of 60 or 50% inclusion rate instead of the 2/3 inclusion rate is a big difference. So there's a lot of uproar about that. Good news is the Carney government said we're not doing that, so it's been shelved, hopefully forever, but at least it's been shelved. It hasn't been postponed. It's just off the table now.
Oh, good.
Which is good news.
And I know dentists, doctors, they also went
Yep.
basically berserk when this happened,
Yeah.
because when they go to transfer,
Try to sell their practice.
Yeah.
That's right.
Okay, good. And I guess you guys weren't happy either.
You guys as tax accountants, or tax
Partners.
Yeah, no, we weren't happy for ourselves, but we weren't happy. We weren't happy for our clients as well. We follow their lead.
Yeah, definitely. Now, the one that pops its head, and it's the ugly head, are CRA audits.
Mm-hmm.
So, and I always ask this question. I ask you every year. I said, what does trigger a CRA audit?
The short answer is there's not one thing. And frankly, I don't know, because I don't work with CRA, right, or for CRA. So I don't know how they determine which individuals or which businesses get audited. Mm-hmm. I think they do look for consistency. So as an example, if you've been filing your tax returns for a number of years, claiming a certain amount of deductions, and suddenly those deductions increase substantially or exponentially relative to your previous filings, I would think that's a red flag that says, hey, let's look into it. Yeah. Sometimes it's just, I hate to say a lottery, but sometimes it's just like, hey, this company hasn't been audited for 20 years. Let's take a look. Mm-hmm. And sometimes, a lot of times, nothing comes out of that audit. It's like, Canada, we have a self-reporting system.
Right.
It's not as if someone sends me a bill, here's how much you owe. It's, I prepare my tax return, I tell the government what I think I owe. So CRA has the right to go back and scrutinize and say, have you paid your fair share of tax? So yeah, sometimes it's random. Sometimes they don't, they don't find anything from an audit, meaning that you don't know anything further. So I don't know if that answers your question, but there's not one thing, but I think it's just consistency is important. If they see a big spike or something that maybe looks a little bit more aggressive, they'll take a look, I'm sure.
Yeah. In my experience, since I started my own businesses years ago, is the stuff, when I do get questions, it really is on a category. So sometimes they'll pick, it seems like they'll pick a category of expenses and they'll just say, hey, tell me about what's in this category, right? Which, for those of you who, worry about it all the time, it's fairly simple, quite frankly. You just have to keep your records, go back and compile what made up that category and send it to them. And
the more common ones that come up are in the categories is foreign tax credits. So if you had any foreign investment income, they want to see that you pay tax in that foreign jurisdiction. Medical expenses we talked about earlier, they'll review those, especially in a year where there's a big amount compared to prior years. Donations are the other ones they like to take a look at. Show your tax receipts to them. So I don't really call those an audit. They're not but they are an audit. But as I said, on a category. So those, as long as you keep your records, usually you have no problem.
The other thing I always tell people too is when you do get that letter, right? And it's usually a fast timeline.
Yeah.
Like, so it's usually they
Usually give
say,
it 30
within
days
so many
usually.
days,
Yeah.
and unfortunately it comes through the mail. So
Yeah.
by the time you get it, you're like, oh man, I got like 10 days left.
Right.
Call. So call the person that's on that letter and talk to them. I always do, when I get the letter, I just call them and say, hey, I just got the letter. I got 10 days left, and they'll work with you. Usually
Absolutely.
they're really good. My experience with the CRA guys has always been very cooperative, very helpful. So, I've always had good experiences. This is one I put on the list, and this is something that, as you know, I lived for many years in the US, and then I came back to Canada. Tax residency was always kind of an issue that you had to monitor and judge. Tell us a little bit about tax residency, and when do you stop paying taxes in Canada? When do you have to pay taxes? So take me through that. I know, I have my own opinion, but you're the expert on it.
This is a really complicated question and not a straightforward answer to it. So in Canada, our tax system is based on residency, not citizenship. So you could be a Canadian citizen living in a foreign country, but haven't worked in Canada, have no income in Canada, have no property in Canada. It doesn't mean you're required to pay tax returns. But as a tax resident, so if you live here, and we'll come back to kind of what that means, you're subject to tax on your worldwide income. So if you earned income in a foreign jurisdiction, in the US, someplace in Europe, the common ones that we see, even though you may pay tax in that foreign jurisdiction, that income or that gain is taxable in Canada. Canada has a great tax treaty network, so that you get to claim a tax credit generally for foreign taxes paid, so you're not paying it twice, but we are subject to tax on residency.
Right.
When you cease residency is, there's no fine line in the sand, it's not a black and white answer. A lot of times, you look at things like, where do you live? Where's your home? Where's your what's called your center of vital interests? Meaning, where do you spend most of your time? Where do you, where is it that you're part of clubs? Where is it that you have a driver's license? You look at all those sorts of indicators to say, well, I'm a resident in this jurisdiction versus this jurisdiction. And you look at kind of the where the abundance of the facts are. So it's, where's the case stronger to say that you're a resident? You talked about the U.S. and there are some states that there's no personal state tax, places like Florida and Texas as examples. So if you think about, so some people will say, well, hey, I'm a resident in Florida because I don't want to pay tax in Canada. It's not so simple. You look at, well, where do you live? Like where even though you might have a home in both jurisdictions, you have to look at those other tests as well. Yeah.
Well, it's interesting, and I was lucky enough, I didn't give up my residency, of course. And it was interesting because I got down to Florida and I went through 2 hurricanes. And, it's funny, I thought when I got down there, I thought, oh, this is great. No state tax. I don't have all the tax issues that we have in Canada. Then I went through 2 seasons of hurricanes, actually back to back. Went to Oklahoma, went through Tornado Alley, and I thought, I'm not staying here either.
Yeah.
And then a friend of mine recently said to me, I'm heading over to Dubai. And believe it or not, just before this conflict in the Middle East, in Iran, I was supposed to go on a vacation, like literally like weeks before it broke out. I was supposed to be on a vacation with my wife in Dubai with my son. And I canceled I thought, this is getting a little hot. I'm going to cancel. I'm not going. And, he calls me up and he says, thank God you didn't come. And the idea of actually coming here, for a better tax scenario.
Yeah. We complain about, as Canadians, we complain about the amount of tax that we pay, but we get a lot of benefits here from our system.
Oh, we do.
And yeah, some jurisdictions, you pay no tax. Dubai, you mentioned, but it's also not a democracy. In Canada, we're a democracy.
Yes.
And so, where do you value having a democracy, a right to vote, a right to freedom of speech and whatnot, relative to not paying any tax?
Yeah. Well, and also we don't, one thing I realized, we get tough winters.
Yeah.
But knock on wood, for the most part, we don't get natural disasters. And having lived around the world, I've seen that. And so when I came back home, that was one of the reasons, family, and also the fact that this is the safest, best place to live by far. And I think sometimes we don't say it enough. We get caught up in the day to day, what's going on in politics and what's going on in the world. But yeah, so it is great. So, and you talked about, this is an interesting one. And, I've looked at it myself, estate freezes. So, and people get to a point where they have to start planning, and it's tough, right? no one wants to think about the end of their life. They want to think about growing and adapting and flourishing. But, you have to at some point sit down and say, okay, if I'm going to do well and I want to leave some money to the people, how do I do that best? So let's talk about estate freezes for a few minutes.
Yeah, so an estate freeze is a simple concept, but not necessarily simple to execute. So if you think about what the word freeze, what it means is you're freezing the value of what you own so that the growth from the date of the freeze onward goes to somebody else, typically next generation.
Right.
How do you do that? First of all, you need a corporation or some other vehicle that can be frozen. So if you just have a bunch of bank accounts, brokerage accounts sitting under your name, you can't just say, well, I don't want to pay tax on any further growth from this point on. You can't do an estate freeze like that.
Right.
So it's either typically you freeze the value of a business or investments that are in a corporation. You can say, okay, well, what are my shares worth at a certain point in time? And you typically go through a corporate reorganization where you convert what are common shares into fixed value preferred shares that don't grow in value. And then a new individual or new entity, like a family trust, subscribes for common shares that are the growth shares that grow from that point on. Mm-hmm. The idea is that the growth goes to the next generation. The tax isn't paid on that growth when you die, the freezor. You only have to pay and plan for tax on your frozen preferred shares. So what that does is essentially allows you to plan. How do I fund that tax liability on death? You can't escape it. And so if you've done a freeze and at least the value, you can plan on how do I fund it through savings, through life insurance, and helps your affairs, help put your affairs in a more organized manner so that your beneficiaries and trustees aren't dealing with a mess, for lack of a better word, on your passing.
It's a shame. So we had an unfortunate incident last summer. A good friend of ours at a very young age passed away. I think I was mentioning that to you on the phone. And it's so sad. This is terrible. And for our family, it was hard because we were really close with them. But we see his wife frequently, and we love her to death. She's working her way through because he didn't have a will, didn't do a lot of estate planning, and now she's kind of grinding away through the process. And I didn't realize how hard it was, but we had lunch with her last week, and she was just telling us the sequence of events that she's going through. And it's such a shame, right? But he didn't think of it, right? He was too young to think about it. My dad and friends told me early on in my life, when I turned 40, start getting a will together, start thinking about an estate plan. It's never too early, right?
I was going to say even 40 is probably too late.
Okay.
Because we've seen, unfortunately, in yourself probably as well, people that die earlier than that out of, car accidents, whatnot. So, unfortunately, I have a client whose daughter passed away in her early 30s without a will. And so it created a mess with children. Wow. So dealing with who should handle this individual's estate. Not that it was significant, but there's some assets there. Who takes custody of the children? All those sorts of issues. Without a will, you potentially have some fighting amongst family members. So having the will that you articulate, here's what I want to happen when I'm not here, is super important. And I would say it's probably like the most important document that everyone should have. It just helps make sure your wishes are followed through when you're not here. Right. And it doesn't have to be a 50-page will if you're younger, but you need a will that deals with things like we talked about, like if you have small children, who takes custody, who you're giving authority to take control of your assets, to deal with them as you wish. But super important document to have.
Yeah. Well, even, honestly, bank accounts, where all your investments are held.
Yeah.
Like it sounds, it sounds, crazy, but quite frankly, there's a lot of things we don't talk, we're busy. Everyone's busy. It's not on purpose for the most part for people, but they don't think to share all that information or to have it centralized or put in a safe or have it in a lockbox or a safety deposit box. But though, again, those are all the things that you should be doing. And I know you do a lot of work in this front, right? This is kind of from your firm's perspective at PwC. You guys have kind of, it's not just tax accounting. It's basically
It's tax advisory is
advisory.
It's the most significant part of my practice and our practice. for
Yeah.
sure.
Yeah. You do mostly planning, right?
Yeah.
Now, since I've met you, just planning people's lives and helping them plan their business structures and where to go with it is a key component from the onset. And it's money. Well, sometimes, you're like, okay, I want to reinvest in this business, but okay, great. But you have to plan the business at the same time because, if you don't, you can, number one, you might make all these wrong moves. You have to go back and try to fix. And quite frankly, you want to maximize your profitability from the efforts you're putting into it.
Yeah. I view my job as a bit of an educator for my clients. You talked about an estate freeze a few minutes ago. I don't expect any client to come in and say, I want to do an estate freeze. It's my job to advise them, hey, have you thought about this? Here's what it is. Here's when it makes sense for you to do it. And here are the pros and cons of it. Because again, this is my business, but this is not my clients' business. They're busy running businesses or whatever it is that they do. So I feel my job is a bit of an educator when it comes to Canadian taxation, the Canadian tax system, things that they should be thinking about to put their affairs in order in a way that leaves their assets to the next generation in an organized manner, but organized to pay the least amount of tax that you need to pay, right? No one wants to overpay tax. But
no. Heck no.
But we have a lot of benefits, right? So, tax evasion obviously is not good, and we don't propose that. No. But you are allowed to organize your affairs to pay the least amount of tax that you need to.
Yeah. Corporations. So let's talk about that for a minute because we're on the corporate side of things. Definitely incorporate a business if you're going to end a business. And then second thing, holding investments in a business. So talk to me a little bit about the benefits, we all, even why you incorporate for a minute, and then we can go on to the investment side.
Yeah. So in terms of a business, as you mentioned, it's almost automatic that you should be incorporating a business. From a tax reason alone, small businesses, so meaning where they have taxable income up to $500,000, the combined federal Ontario tax rate's only about 12%. So as an individual, if you made $500,000 up to $500,000, your tax rate goes up to 53.5% once you hit $250,000. So massive tax differential earning income in a corporation versus individually.
Right.
So there's a tax benefit. I'm not a lawyer, but there are obviously legal benefits too to being incorporated. The fact that a business is incorporated should protect the shareholders from personal liability if there's a lawsuit or something like that. Whereas if you run a business your own, you're potentially exposed to creditors.
Right. Yeah, definitely.
So I would say those are some of the things to think about in terms of incorporating, not incorporating. In terms of investments, this one's a little bit more not as black and white in my mind. Most of my clients, I would recommend that they do incorporate their investments for different reasons. One, the tax rate is slightly less in a corporation than it is personally. Investment income is taxed at just over 50% in a corporation. As an individual, if you're in the top tax bracket, you're paying 53.5% tax. So there's a little bit of a benefit there. There's also, we talked a little bit earlier about having assets outside of Canada. In Canada, a lot of people have U.S. investments, whether it's marketable securities or real estate or whatnot. The U.S. has an estate tax that's payable on death, and that's applicable to Canadians too, potentially, because you are subject to U.S. tax even if you're not an American.
Right.
So Having assets in a corporation can help with eliminating U.S. estate tax on those assets. So those are the main two reasons that why I see a lot of clients incorporating their investments.
Yeah. Just before, and I want to get on to simplicity of tax for a minute, but I'm going to put any more strategies on the tax front we should be thinking about, corporate or personal, that you want to kind of drop with us today. I know.
Yeah, we could spend another 5 hours talking about this, but the one thing I think I'll mention here is flow through shares. Is a topic we hear a lot about that gets a lot of profile. And what that is if, investing in a flow through share, these are typically junior mining exploration companies in Canada that, because they're at the early stage of exploration, they need a lot of money to do that exploration. But they don't need the tax write-offs because they have no income at that point.
Right.
So there's this product, if you want to call it that, where you as an investor can invest in shares of that corporation that are specific and meet a bunch of rules in the Income Tax Act, that they can flow through those expenses essentially to you as an investor.
Okay.
So you get an immediate deduction for the investment in that flow through share, as opposed to just paying a capital gain when you sell it. And so that helps on two fronts. One, it helps you reduce your personal taxes if I can get immediate write-off for a $100,000 investment, but it helps that company. Now they have that $100,000 to invest and explore and we hear a lot about critical minerals. Find those critical minerals that are an important part of the economy going forward.
Right. I never think about it. It's interesting. We do tons of mining shows now, and this is one I'm probably going to have you back in for to talk about, because this is a real key. And it ties into the next thing. So, which is really good segue. I don't know if you knew you were segueing maybe into this, but Australia. Mm-hmm. So I'm going to compare for a minute. So we took a look before the show and we said, okay, and many shows we're looking at Australia right now because its productivity level is increasing so fast. And Canada's has kind of stagnated. Mm-hmm. So we see a country that right now GDP per capita is about 10,000 more than ours. Whereas, a decade or so ago, it was below ours. Now it's extreme. They've done some things to simplify their tax system. Is there stuff in Canada right now, and I really find this interesting because and it's a shame, we're kind of slipping out of the OECD, the developed country list of 32. We're slipping out in productivity levels, because we're just going down and down and people are growing. Mm-hmm. We see the US growing, we see the gap between us. So we're seeing the productivity levels shift. But when you look at the rankings for complexity of tax systems, we're number 13th in the world in the OECD. So we're one of the more complex tax systems, but yet we're finding, is there ways that we can, and this one, the flow through shares, is there other ways that we can start to incentivize people, reduce complexity, so we can kind of get that productivity back and try to grow our country? And I know the Prime Minister talks about it quite a bit. And, it's a shame sometimes. I know he's a really bright guy, but, more details like this to explain to people what he's trying to do, I think would be helpful to get people on board to what he's doing, right?
Yeah. I mean, this is my own opinion. I'm not what I say is I'm not representing anybody here, but just my own kind of observation, being a tax professional and doing this for 30 years, is I think our personal tax system can be simplified. I think there's, one of the first questions you asked me is about tax deductions and credits. Why are there so many? Mm-hmm. Right? My own view is I'm a bigger proponent of increasing the exemption. Right now, it's only about approximately the first $16,000 of income that you can earn tax-free before you start paying $1 of tax.
Right.
Why not increase that to something more meaningful? And I don't know what that number is, but let's say 30,000, 35,000. But do away with some of these credits, like the medical expense credit, or there's credits for moving expenses, childcare expenses, whatnot. May not be popular for me to say that, but I think it just simplifies the system. Why keep that big stack of medical expenses?
Yeah.
Just increase the exemption. And so just say, okay, oh, you don't have to pay tax on X, but don't worry about keeping all those records, because at the end of the day, how significant of a savings is it going to be by claiming a few dollars of tax savings on medical expenses? So that's my own opinion, is there's too many credits and too many tax brackets that if I was Prime Minister, I would do away with a lot of that. Which, alleviates some of that anxiety you talked about when it comes to tax time.
Yeah, it's interesting. So, we took a look before the show, and different countries, they've done, we looked at Switzerland, which is a smaller company, and we looked at New Zealand. They'd kind of switched off to more of a flat tax structure. And then Australia, which you just talked about, did an increase in their lower level of, tax exempt income for people. So it's really interesting. That is a good suggestion. I think we need to look at it now. I think we're at that point. If we can find, the simplest ways to free up people's time to become more productive. So if I don't have to stress, worry, go out and spend time to, like you said, compile, put together, we can build more. And I think that's what Canadians need to be doing now. And I hope, for this show, people listen. Recommendations going forward, very helpful. Before you go, and I just wanted to thank you for coming in today.
Thanks for having me.
But I also, for people, Luigi, as he said, and I'm gonna sing his praises for a minute. Probably one of the easiest guys to talk about tax with. So, I've met a lot of tax. Trust me, I've met over 100 tax accountants that I've had drinks, dinner, lunch, you name it. He's very easy to talk to. He has great ideas on tax planning. PwC is lucky to have him.
Thank you.
And I really appreciate you taking the time. So
thanks for having me on the show.
Yeah. And, so for those of you, please keep him in mind when you're doing your tax planning, and also subscribe, like, and let us know what more you need to know about tax, because we're always really excited to have him back and have more shows. So thank you.